Ken was going to give an update on small business and just general economy.
Yeah, what I thought I would do both is, as you said, general economy and small business, and one say that traditionally we've been a leading indicator by around 6 to 12 months for the economic environment. And that's been pretty clear as you look at the past 15, 20 years. What I'll go through is what I'm seeing, but also some concerns that that may not be the case going forward, because I think based on what's happened.
Meaning you may not be the same kind of.
That's right. We may not be the same type of indicator, because I think with the event that happened once in 100 years, there are some changes in consumer behavior. There are some changes from a regulatory standpoint that might slow down that growth. But the first point I would make is if we look at card billings, and in our business model we have large percentage, 70% of our billings, 713 billion, is driven by people who pay in full at the end of the month. It's a major difference. And then you have 30% that revolve. And there's some fundamental differences, and you can see the change in revolving behavior that has taken place. In the US, the billings growth rate was 13%, but the overall industry growth rate for the credit card side was 6%. So already you can start to see a demarcation, and I'll talk about some of the drivers of that demarcation. And the question is really, given the credit situation, if we're going to see a real increase in that 6% number. So that's something that I think we just need to focus on. Small business, we have seen real improvements in the last year. Small business was a big concern over the last 12 to 18 months, but in 2010 we saw a comeback. So that growth rate was in double digits, low double digits, but good, strong growth, and that is continuing. And small businesses we characterize anywhere from 10 billion to 1 billion in sales. The other side is commercial, large commercial card, which is mid-size companies, and that's the group that's really 10 million to 1 billion is mid-size companies, small businesses below that. But middle market and large corporate, we saw a 19% growth rate, which we were in negative territory 12 to 18 months ago. 19% growth rate, and that is holding pretty well. And frankly, in conversations with a number of my technology peers, they are seeing good growth on the technology side. So I think that is certainly encouraging. And across almost every industry category, period, we're seeing positive growth. A number of categories in low to mid double digits, other categories in the 5 to 7% range. And so that is quite encouraging. What we're seeing, though, is a real demarcation between the affluent consumer and the lower middle class consumer. So the growth rates for the luxury affluent spender have been very strong. So you're seeing in some segments growth rates of over 35% for spending. You're seeing a switch of what I'd call traditional affluents who comprised, while they were 10% of the people who were spending, they were driving 60 to 70% of the spending. They are now driving 38% of the spending. And what you're seeing are newcomers, younger people who are in fact not as affluent, dramatically increasing their affluent purchasing. And we're trying to get behind that dynamic. Because it's an interesting dynamic that you have a young group. Obviously, a substantial percentage of that group is doing their spending online. And I'll get back to that, and that's an important change. Just on online spend, and this is, I think, a sea change that's going on. Fastest growth category is online spend. So our online spend is growing 20% plus. PayPal is growing 20% plus. We're generating easily in excess of $100 billion in online spend. PayPal is generating around $92 billion in online spend. The penetration of retail is only 10 to 15% of online spend. So that's a long runway. Obviously, if they're online, then they're being serviced online. The short-term impacts from an employment standpoint could be substantial because the productivity is going to be impacted. From a growth standpoint, over the next 3, 5, 10 years, I think you're going to see an increase in employment as a result of that growth. But I do think there is going to be a short-term hit, and that's a concern as I look at that. So I think that's important to focus on. I think that what you're seeing from a behavior standpoint as far as revolving credit and lending is people are revolving less. Given the environment, they're saying, I'm going to pull back. I want to be more responsible in my lending. People have less access to credit. I think one of the consequences of the Credit Card Act, which generally I think was very good, is the impact has been on risk-based pricing. So people who are less creditworthy, institutions are less willing to extend that credit to them, and that's just a balancing that I think is going to be very, very important to go through. If you go to 2010, revolving credit balances were down 8%. We were flat to down 1%. So it's going to take a big change, a major sea change, to go from this decline to 5 to 10% growth in AR.
Can I just interrupt 1 second?
Sure.
I think in your industry there was some question as to whether consumer patterns were actually changing.
They are.
Where people were using the credit card less, or whether this was an aggregation issue, and what you found out was there were a whole bunch of folks on the sort of downstream who just lost their credit cards, defaulted, et cetera. The people who hadn't lost their credit cards, that they were still using them just as much. I wasn't sure how that resolved.
Here's the balance. I think that people are not utilizing the credit on their cards as much. So I would say that the change has been more.
So there has been a change in behavior across the board.
There has been a change of behavior, and let me give you an example, is that the rate that people utilize their lines is in the 20 to 25% range. So you've got 75% of the lines that are out there that are unused, both in consumer and small business, and that's pretty consistent. So that is a major change. Now, when you ask customers what's the issue, what they will say is uncertainty. Uncertainty about the economic environment. Can they really invest? Are they going to take that risk? So they're being, on one level, very rational. But that is a very alarming number to me, that 75% of the credit out there is not being used.
We're seeing the same thing. The city's
Right.
seeing the same thing, and
That's
our
right.
book is all credit cards, right?
That's right.
People
So-
are paying their balances down,
Right.
and they're not accessing
Right.
the future lines,
Right.
and then the banks are pulling back on those. They're taking back the future exposure just so they don't have it. So
But the concern I have is with the lower middle class, they don't get the access to credit, and those small businesses that have a more riskier profile, at the end of the day, financial institutions are being more conservative because they don't have the ability to dynamically risk-based price. And so sorting out that balance, but I think this behavioral change is something we really need to focus on, as well as how do we make credit more available to certain segments going forward. The credit performance is improving dramatically. So in the fourth quarter of 2009, the write-off rate was 10.1% for the industry. The write-off rate at the end of 2010 was 7.7. And to give you a sense at which we're hopefully a leading indicator, in 2009 we were 7.5. We finished the year at 4.4. And in January, we were 3.8% write-off rate. So we're very much back in our normalized range. And I would say, so for us, while we're the leader, I'm encouraged by what's happening with the industry overall. Now, there's a dynamic that's going on here is people are taking the benefit of their credit provision. Some are putting it right to the bottom line, and some are investing. What we've done is we've invested a substantial portion of that benefit, which is pretty much a one-time benefit. So that benefit is going to roll off at the end of this year. And so what's going to be interesting, while a number of financial institutions are reporting good profits, what's going to be critical is how they've invested that excess provision. And that's why some analysts are really questioning, particularly in the credit card industry, if the earnings growth is going to continue. But I think some institutions have taken those benefits and they've invested in them, and that should bode well. So I think clearly consumers and small businesses, we've got to solve this credit issue, making sure that the lower middle class has more access to credit, because now they have less access to credit. So in summary, what I would say is we need to stay very focused on this demarcation between the affluent and the lower middle class. There are clearly two very separate dynamics going on, and it's not necessarily, as I look at it, we're going to see the trickle down that we've seen in past economic crises over time. Second is, how do we change and make people aware and give them incentives to utilize the existing lines? Because to have 75% of the lines not utilized from an industry standpoint is highly concerning if we're going to drive growth. And third is access to credit. The last piece I would also mention is this impact of online spending on traditional retail is a very, very important impact, because while it is very productive, the growth rates are tremendous, we're investing in it heavily. In the short term, even with traditional retailers, the fastest growth part of their business is online spending. And that will have a short-term impact, and we just have to balance that off and understand what are some other industries that we can really drive towards that will help with the short-term drive for jobs, as well as plan for what will be the growth opportunities as a result of this move to digital.